Good morning from our global headquarters in New York City. I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda. All eyes on Switzerland. Representatives from Washington and Beijing gear for trade talks over the weekend. China exports to the U.S. slump, but soar everywhere else, igniting fears that cheap Chinese goods will flood European markets. And a slew of Fed speak on deck to wrap up a big week for central bankers as the Fed's dual mandate comes under pressure. Well, we are trying to eke out something of a gain this morning. Ignore the Russell 2000 futures. Those are not trying to eke out a gain. They are decisively down this morning after gains yesterday, after we got pummeled with trade headline after trade headline. We are still headed for decline for the overall week. Michael Harton at Bank of America writing in a note this morning that the rally on those trade deals is over. Buy the expectations, sell the facts. Now, for this bond market, it was a huge sell-off yesterday. We ease off of that somewhat, some steadiness coming through the bond market. But yesterday, 10-year yields higher by 10 basis points. We breached 438. We fall below that this morning. Your 2-year yield, that is also down 1.5 basis points this morning at 385. Those are your overall markets. Let's get you some stocks to watch this morning. With that is Bloomberg's Joe Easton. Good morning, Joe.
Morning, Danny. So Expedia, one of the big decliners today as the travel company downgrades its forecast for earnings, seeing weakness in bookings of people travelling into the US, kind of in line with some of the data we've seen from the industry recently. That stock down almost 10% at the moment. Then we're also looking at Pinterest. Much more exciting for the social media companies, saying that they are harnessing their AI to use their client base to get more advertising revenue. That stock really rallying up almost 13% for Pinterest. And then we've got numbers out of Lyft as well. This one was a little bit better than we saw from Uber recently this week. The company saying that it had seen a 16% jump in its bookings in terms of its rides at Lyft. Keep an eye on that one and catch up with all of those on the Before the Bell opening wrap on the terminal now, Danny.
Joe, excellent work as always, and we'll catch up with you later in the hour. That is Bloomberg's Joe Easton. Also in this hour, in just moments, we're going to be speaking to Isabelle Mateos Lagos of BNP Paribas. And later in the hour, Jay Woods of Freedom Capital Markets will join us around the table. Now, Isabelle Mateos Lagos of BNP Paribas weighs in on the latest trade deal with the UK and the upcoming talks with China this weekend, writing that they are, quote, both positive signals, but merely confirming the no recession scenario that seems to be consensus right now is still plausible. It's no grounds for exuberant optimism beyond that. I'm joined to say that Isabelle joins us now. She's chief economist at BNP Paribas. So, Isabelle, what does a UK deal and a potential upcoming talks with China change for you?
Well, it confirms that the Trump administration is serious in wanting to reach trade deals and reduce the pervasive uncertainty that the tariffs are created. So, in that sense, that's positive. But it's important not to get overly excited. For one thing, this UK deal was probably one of the easier ones to strike. Not to minimize the amount of hard work that's been put in by both sides, no doubt. But let's remember, the US actually has a surplus in trade goods with the UK. So that obviously is a more favorable context than in the trade talks with the EU or some of the Asian partners. And secondly, it was very helpful to see, well, what is negotiable and what's not. We can't be sure that this will be precedents for all the deals, but it's interesting to see that the 10% reciprocal tariff stays, no going down there, whereas the sectoral tariffs, notably on steel and on autos, which I think people were expecting would be harder to negotiate down. Well, actually, the UK managed to make some headway there. So that's a useful signal. The fact that trade talks with China are going to start this weekend is very positive because, frankly, these monumental tariffs that the US and China have imposed on one another are probably the biggest threat to global trade at this particular juncture. And so the fact that talks are going to start means we now have a reasonable prospect that they will be coming down. So all this is positive. The one caveat I would have is the central expectation from pretty much every forecaster out there was that we would see a decline in uncertainty and in some tariffs over the course of this 90-day window that President Trump set. And so this is the beginning of this probably happening, but this is just putting us in line with the central scenario, nothing better than that.
Right, and what we've gotten from the UK, Isabelle, I think a lot of people were underwhelmed by it. And as you pointed out, the 10% tariffs stay on, and then you have some other adjustments around the edges. But it is a framework with more things to be negotiated later, and it's the easy one, again, to your point. So if there still is uncertainty, because let's be honest, trade deals take a very long time to figure out, how long does that uncertainty need to last for there to be real economic damage? Are these little bits of headlines enough to alleviate that threat?
No, for sure they're not. And as I was saying, I think the key piece right now is to get to a de-escalation of the U.S.-China tariffs, because at the level they're at, this is basically a trade embargo, and in a trade embargo you end up with empty shelves very soon. And we learned in the pandemic that supply chain disruptions are the kinds of things that create massive spikes in prices and are things that are much harder to control than the linear minor increase in prices. So I think these talks that are kicking off on Saturday are extremely important. And if we can get, ideally a decision to suspend the tariffs from their highest level, or at least a pointer that this could happen relatively soon, I think that will be critical. But if the uncertainty remains at the level it is at now for more than a few weeks, it's going to do irreparable damage.
There's a New York Post report yesterday that the U.S. administration is looking at slashing Chinese tariffs to as low as 50%. They're currently at 145%. 50%, Isabelle, would still be the highest likely since the 1940s that we've had in tariff rates. How much enthusiasm would you have if we do go down to 50? How much does that, how much economic damage would that or would that not prevent?
Well, that would be very helpful. I mean, in our central scenario, we're assuming a landing zone of around 50 to 60%. So on China. So as you say, it's still prohibitive, but it allows some trade to happen. And more importantly, I think it would signal that the goal is not to completely kill any kind of economic relationship between the two economies. It would still probably get a lot of prices to go up in the near term. It would still generate some very significant rejigging of supply chains towards reshoring in the U.S. I'm not sure, but at least a reconfiguration of that particular supply chain. But it would be more manageable. But you're right, it would still be a major sand in the wheels, very much like the 10% tariff that is remaining in place in the UK is almost a 10 times increase over what was prevailing back in January. So, we shouldn't get overly excited. But I think the more we can converge to these less prohibitive levels of tariffs, the more we are in line with the consensus central scenario, where the US gets an acceleration in inflation, but something that remains, contained below, say, 5%, and a very shallow growth path this year, but not a very tricky recession.
A lot at stake this weekend in those talks. Isabelle, really wonderful to get your thoughts ahead of them. The perfect setup heading into the weekend. Isabelle Mateos, Lago, enjoy your weekend. And a quick programming note, don't miss our exclusive interview with Fed Governor Adriana Kugler and New York Fed President John Williams. They'll be exclusive from the Reykjavik Economic Conference. That's at 7 a.m. and 9 a.m. Eastern, respectively. Let's get you some other top stories now that are trending on the terminal this morning. President Donald Trump is pushing lawmakers to hike taxes on some of the wealthiest Americans to offset some of the other cuts in his signature economic package. The president's proposal calls for a new 39.6% tax bracket for individuals earning at least $2.5 million or couples making $5 million. The current top rate for individuals is 37%. Tensions escalating in Asia after India said it neutralized Pakistani drone and missile attacks targeting several military sites on Thursday night. India's defense ministry says military stations in some of the northern cities were targeted and no casualties were reported. Pakistan denied that it launched the attacks, saying the claims were, quote, politically motivated. And in corporate news, IAG announcing a major order for 71 large jets from Boeing and Airbus to grow its network. The parent company, British Airways, is doubling down on its long-haul business to keep up earnings momentum with a $10 billion fleet investment. The company maintained its outlook, citing good demand for travel across its core markets. Coming up, as we've been discussing, U.S. and China negotiators head to Switzerland for much-anticipated talks. We'll have more on that coming up next on your Bloomberg Brief.
Any country or any groups of country talking about isolating China, do you know what's the response? We chuckle. Because from my perspective, it's a mission impossible.
If the Chinese don't want to renegotiate, well, that's their choice. But it is American options for what they want to do that is driving this. It is not holding a gun to the head. It is trying to take a different course in history.
It's reasonable to expect that a similar approach could happen with China and that the negotiations or the tariffs could be paused for 90 days while the two sides negotiate. And I think almost anything less than that is going to be seen as a disappointment by markets and by observers.
Now, we got some trade data out of China overnight, and it showed that exports from China to the U.S. dropped 21%. That decline, though, was made up with exports to other nations in Asia and Europe, which jumped 20% and 8%, respectively. All of that coming ahead of the U.S.-China trade discussions that are set to happen this weekend. Joining us now is Bloomberg's Jenny Marsh. Jenny, if we could just start with the data that we got overnight. Maybe it was expected, but does it reveal a threat that there are cheap Chinese goods that are dumped elsewhere in the world?
Absolutely. I think that is going to be the concern regionally now from China's trade partners. You know, even before this trade war kicked off with the US, the European Union had already been complaining about a glut of cheap Chinese exports, and so had many regional partners in Asia. And the data today just sort of reveals those fears are confirmed, really. You know, and this is just the data for April. Where tariffs are sort of rising throughout that month. So I think, you know, the expectation is that sort of the May data will show these trends even more starkly. So, you know, I think this data really does lay out here where the tensions politically are going to be for China as it tries to sort of build more friendships around the world during this fallout, while, you know, facing all these concerns about its exports going to other markets.
So that's the backdrop, perhaps, for a meeting this weekend with, from the U.S. side, Jameson Greer, the trade representative, as well as Scott Besson. What are we expecting from the talks in Switzerland, Jenny?
I think going in, you know, expectations are reasonably low for any sort of big deal. They're not going to come away with something which solves all of these issues overnight. But I think, you know, they haven't flown halfway around the world for nothing. We had a story today, sort of with people familiar with how the US is thinking, you know, and we're hearing that basically the US is going into this with a target of lowering tariffs to below 60%. And those cuts could go into effect as soon as next week. They also want China to remove export controls on rare earths that are essential for making magnets. And there's been some sort of real trade and sort of pain around that area. And then from the Chinese side, they're getting close to sort of offering something on the fentanyl problem, which would then help the US lift tariffs on that issue. There was a 20% tariff there before the Liberation Day tariff came into force. So it does seem like there's an area sort of and potential for real progress, although obviously, you know, lowering tariffs to 50% even would still be enough to almost decimate trade between these two economies. But as a starting point, from this very sort of extreme scenario they've ended up in, it does seem like actually something could come out of this.
To what extent do we see from the Chinese side, especially this week with various moves from the PBOC, that this is a country getting ready to dig in its heels and deal with economic hardships that might come as a result of wherever the tariff level ends up?
That is definitely sort of the line they wanted to project. And it is hard to know, how much of it is just sort of trying to position yourself to have the best negotiating power you have going into these talks. The Commerce Ministry, again, yesterday was saying, that the US needed to remove all of the tariffs it's imposed in order for them to sort of make progress. And you did see Pan Gongsheng on Wednesday in the briefing that they held, cutting virtually every rate the PBOC has, giving across-the-board support to small businesses, tech innovation. And the signal there really was, we have the tools to support the economy from this hit, from the trade war, and we're ready for a protracted war. If that's what we have to do, we have the tools to accomplish it. So I think the Chinese go in from a very strong standpoint. What we're hearing too is that in some ways the US is underestimating just how confident the Chinese feel about this. I think, Trump has talked about the Chinese economy being in bad shape and not being able to afford this. But I think from where Xi Jinping is sitting, he does feel like they've got everything they need to sort of tough it out, and the economy is a lot more resilient than the US is giving them credit for.
Jenny, thank you so much for helping us set up that conversation over the weekend. Jenny Marsh out of Hong Kong. Coming up, a new pope. We head to Vatican City for more on the first American pope. He's a Chicago man. We're going to get more on that coming up. Stay with us on your Bloomberg Brief.
Let us pray.
Let's get you some front page news and look at what's making headlines across papers. This morning, the FT on their front page. This is a surprising one. German stocks hitting a record high, which you maybe have missed. Trade optimism swirling in markets ahead of U.S.-China trade talks and the U.S.-UK deal. The DAX rising over 0.5% in early trading this morning. Germany also confirmed its new chancellor this week, and that Chancellor Merz talking about that he's spoken with Trump and they agree on the need for a trade deal. Next up, the Wall Street Journal cools that optimism with this headline. Trump's bespoke trade deal with the U.K. sets little precedent for other nations. Foreign officials telling the Journal that the deal, limited in scope and including niche issues, doesn't offer nations a roadmap in negotiations. And finally, on the front pages around the world, including Bloomberg, a White Sox fan called Bob from the south side of Chicago becomes Pope Leo as the world faces turmoil through conflicts and trade wars. We also have some live shots from Vatican City where Leo XIV is giving his first mass as the leader of the Catholic Church. That is not him right there. We heard from him earlier. Again, it is his first mass with the cardinals in the Sistine Chapel. For more, we are joined by Bloomberg Rome reporter Flavia Rotundi, who is outside the Vatican. Flavia, just give us a sense of a mood. We had the white smoke yesterday, a little over 24 hours, and we have our new pope.
Yes, good morning. Well, definitely quieter today. Yesterday, it was a chaos, I must say, here on the square, cheering crowds, high emotions, and also sense of surprise because, as you say, the Cardinal Paribas was not at the very beginning considered maybe one of the key contenders in this conclave, but his name actually started circulating after lunchtime yesterday, after first round of voting. Actually didn't manage to get a successful results, a quorum by the cardinals. And so the idea was maybe the Italian contender Parolin and other Philippine contender Tagle might not be the right person. So yes, today is quieter, but at the same time, the agenda of the new Pope is already full, as you say, he just said, yes, he's actually celebrating a Mass here in the Sistine Chapel, just with the cardinals, is kind of open to the public in terms of being broadcast live, but nobody else is admitted. From tomorrow, things will be different. On Sunday, there will be the official Mass in St. Peter's Square. Actually, we'll speak to everybody. And particularly on Sunday, I think the focus will be on the first message of the new Pope. What we want to achieve, what message he wants to send to the rest of the world, what the first reforms might be. We know that the new Pope is very knowledgeable from the point of view of being, from this theological point of view, has strong diplomatic skills, and so this should help him in terms of navigating these very difficult geopolitical times.
Okay, Flavia, thank you so much. That is Flavia Rotondi. And again, just beautiful shots there at Vatican City and inside the Sistine Chapel, where we're hearing from the first Mass from Pope Leo XIV, the first American Pope and Chicago man. I wonder what he has to say about the White Sox. Really, really gorgeous images. Okay, let's get a look at maybe a less gorgeous image and what markets are doing this morning. S&P 500 futures attempting to gain. We are still down on the week, though. We are basically unchanged. We're unchanged on the 10-year yield after yesterday's 10 basis point move higher. Coming off the show, nearly 80% into this earnings season, a growing list of firms warning on expected damage from tariffs. We're going to catch up with Freedom Capital's Jay Woods. That's coming up next on your brief. From our global headquarters in a very cloudy New York City morning, welcome to Bloomberg Brief. I'm Danny Berger. Let's set your agenda. All eyes on Switzerland. Representatives from Washington and Beijing gear up for trade talks over the weekend. Meanwhile, China exports to the U.S. slump, but soar everywhere else, igniting fears that cheap Chinese goods will flood European markets. And a slew of Fed speak on deck to wrap up a big week for central bankers as the Fed's dual mandate comes under pressure. We attempt to do something of a gain this morning, a weak attempt at that. It would be another day of gains. We did gain yesterday, but we're on track for a decline for the overall week. Michael Harden at Bank of America writing that the tariff-related rally is likely over. Buy the expectation, sell the fact. Russell 2000 dips 1/3% for this bond market. It was selling yesterday. 10-year yields moved higher by 10 basis points. A little change this morning, just under 438. Your 2-year yield, that's lower by just about 1.5 basis points at 385 this morning. Let's now get some stocks that are moving underneath the surface. Here with that is Bloomberg's Joe Easton. Hey, Joe.
Hey, Danny. So Expedia, really the stock catching the eye at the moment. We're down close to 10%, now around 9% for Expedia. The company cutting its booking forecast, citing weakness in terms of tourists coming into the United States, kind of what we've seen in the industry data at the moment. So that one, a real weak one today. Then a couple of decent movers to the upside. Firstly, Pinterest in social media. The company says it's harnessing its AI capabilities to entice companies to advertise on the platform. Now 570 million users of Pinterest, according to their statement. That one up almost 13%. And then Lyft cutting its prices in order to take market share away from Uber. It's kind of exactly the opposite to what we saw from Uber earlier this week, with Lyft beating expectations, sending that stock up almost 8% in the pre-market. Keep an eye on Lyft ahead of the open in New York, Danny.
Joe, excellent work this week. Thanks so much for joining us. That is Bloomberg's Joe Easton. And look, Joe underscored it there. It has been a busy week. In fact, it was the busiest week of U.S. earnings of this quarter, and it is now drawing to a close. And companies have been reporting tens of billions of dollars in expected damage from tariffs. Both Ford and Nvidia, for example, warned of at least a $5 billion hit. Many others declined to give any guidance at all. In fact, the word uncertainty was said more than 9,000 times in earnings calls. That's more than COVID and the most ever recorded in Bloomberg data. Well, one man who's been watching earnings very closely, Jay Woods, Chief Global Strategist of Freedom Capital Partners, joins me now. Jay, so wonderful to see you.
Good to see you.
Has this been a fun earnings season?
It's been a crazy everything season. Every time you turn around, there's a new headline. This weekend, we're probably not going to get the rest as we watch what's going on in Switzerland.
Correct.
So, you know, one data point at a time, as Jerome Powell says, and we'll deal with what comes later today.
Well, what have been your takeaways from this earnings season? It's been very uneven as to whether we hear about some damage, whether we don't know, a couple bright spots. What did you leave with understanding about corporate America?
Well, you just nailed it. Uncertainty is the word of the year, maybe the word of the decade at this point. 9,000 times. That's insanity. Jerome Powell used it 13 times, or a variation of it, just in that Fed meeting. So we are at the whim of Washington. We're going to continue to be, but now we're watching that guidance. Look at what Apple did. They gave 2 sets of guidance. If the tariffs continue in this way, we could lose $900 million. For GM, they kind of pulled back, and they said the tariffs are going to have severe implications. So this uncertainty theme continues until we get some clarity. We may get some clarity on data next week, but what we're looking for is clarity out of Washington. So we got to deal with our little brother in England. Okay, great. You know, this is what we expect. But what's going to happen with China? You know, Britain just did a deal with China. It took them 3 years to hammer out this deal. We're supposed to do 90 deals in 90 days. I think the market is getting tired of hearing this rhetoric, and now we are at very interesting levels to watch. But on the earnings front, watch Walmart next week. We want to hear guides. Walmart gave a pretty bad guide. Well, it wasn't pretty bad. It's still unbelievable for Walmart, but they reined in their earnings last quarter. The stock has never recovered. It got back close-ish to those levels, but now it's starting to turn over again. Let's see what the shelves are, what the inventories are looking like, and what their future prognostications are, because if they cut guidance again, if they warn, I think that's a sign of what's to come over the next 3 to 6 months.
Is that a sign that just consumer discretionary, consumer staples, that you can't really be buying that sector right now?
You want to stay away. Some of the staples with nice dividend plays are okay. Coca-Cola is doing great, but yeah, it's hit or miss within that sector. To me, we've had a nice relief rally in discretionaries. It rallied, I think, 15% from the low. Technology up 21% from the low. These, to me, are relief rallies, and right now we're at this pause. And as a technician, where did we pause? Right under the 200-day moving average. Where didn't we get back to? Right before when Trump was elected, 57.83. So 57.45, 57.83, these are levels. And then the price action yesterday, we rallied. Trump said, go buy stocks. And guess what? At the end of the day, that last 30 minutes was pretty ugly. So let's see what we do today, what comes out over the weekend. If we get good China news, then you know, all bets are off. We're going to probably rally a little higher, but, you know, COVID, we were down, you know, below that 200-day moving average for 2 months. You know, a V-shaped bottom recovery. People expecting that V-shape. We got a lot of work to do. There's been a lot of damage done, too much uncertainty. So we got to wait and see.
It is remarkable. It feels like this is an administration that is throwing trade headline after trade headline, maybe intentionally, maybe not, at this market, trying to get it to rally. I mentioned before, Michael Hartnett of Bank of America said, just fade that rally, that we basically have gotten as much juice as we can get out for these trade deals coming forward. Would you also fade any of these trade-related headline rallies?
That's what we've been talking to with the Friends of Freedom. We've been just saying, you know, let's go back to the sideline. You know, there were some good opportunities when this market washed out. It was overdone. Sentiment at historic lows. Now, you know, the RSI oversold, came back. So we had signs of the washout. I think the lows are in. For us to get back to where we were, to have that kind of fear, that kind of panic, I don't know what it would take us right now. But the earnings have been okay. You know, 78% beating right now in the S&P 500. You know, 402 reported. A little lower than last year at this time, but still solid given the cloud of uncertainty. So I don't know what's going to be that catalyst to take us back over and get us on that winning track to talk about new highs. That seems foolish. The S&P is down 3.2% for the year. April was almost flat, but the volatility in between there has been crazy. We'll get pockets of it now and then, and we'll see what happens over the weekend.
You also mentioned before that tech has done so well over the past month. And even in the tech earnings, they're still spending big numbers. I think both Meta and Alphabet somewhere around $70 billion for CapEx.
Yeah.
Does tech continue to be this beacon of safety like we've seen it been in other turmoils like COVID? Or are we just repeating that playbook?
Well, pockets of it, yeah. The CapEx spend was like, if you could pull back, that's where you should pull back, but they're not. So that is a good sign of things to come. But I think all eyes are going to be on NVIDIA on the 28th, I believe they report. That is where the CapEx spend goes. So let's see how that's polling over. They have not recovered from the DeepSeek sell-off in January, and their news has been okay with the exception of that little warning. So to me, NVIDIA will be a tell, but until we get to that, you know, I would take profit in some technology names, although we got good earnings. Disney was great this past week, and technically, it's turned the tide. So if this pulls back to 199, I think it's a good opportunity to buy. I wouldn't chase right now. Uber, not a bad quarter. Yes, we focused on gross bookings, but overall the numbers were solid. And you know, technically it broke out above 80. Risk-reward setups are there. So there are pockets of strength. Technology, Meta, and Microsoft doing well, but Apple breaking 200. So it's an individual stock picker story, which it always should be, but the tide is not going to lift all boats in this market, so you really have to sift through the rubble to find the winners here.
Jay, I feel like if we were to ask most people who are more casual observers of international markets, and we said, what is the DAX doing right now? I don't think many of them would think that it's at an all-time high.
No.
What do you make of that?
Well, Europe is where it's at right now. If you look at the global markets, the U.S. is the laggard. So we've seen a rotational theme away from America into the European markets. How long does it last before that American exceptionalism comes back? It's going to take a few tariff deals and a little more simmering of the rhetoric that we've, brought upon ourselves. So right now, yeah, Germany looks great. Japan is come back. I mean, there are a lot of foreign markets that you would rather be in right now than the U.S. And if you're looking for safety, these are safer markets. It's more stable.
Well, Jay, I wish you the best of luck for this weekend. I'd say I hope you can relax, but I think we both know no one is going to be relaxing this weekend.
Yeah, we'll be following Twitter pretty closely. So.
At least we got a new pope. There's some exciting news there.
That is exciting. Pope Leo.
Pope Leo XIV.
He grew up, Philadelphia area. Us Philadelphians are taking credit for him. But
all right, I think that's fair. We'll give it to you. I think every country, Peru is also taking credit. There's a lot out there.
They should. But let's see if he can fix the White Sox. I know he's a big fan. That would be a miracle.
I'm sure there are going to be a lot of prayers going that way. Yeah. Jay, it is such a pleasure to have you. It's been far too long. Please come join again soon. That is Jay Woods of Freedom Capital Markets. Let's get you some other stories now that are trending on the terminal this morning. China's exports to Asia and Europe soared last month, while volumes to the U.S. slumped due to eye-watering tariffs at 145%. The data is the first glimpse at the damage of the trade war. Shipments to the U.S. fell 21% from a year earlier, with many analysts predicting that sustained tariffs will eventually see a trade relationship worth $690 billion last year crumble to zero. President Donald Trump is pushing lawmakers to hike taxes on some of the wealthiest Americans to offset some of his other cuts in his signature economic package. The president's proposal calls for a new 39.6% tax bracket for individuals earning at least $2.5 million or couples making $5 million. The current top rate for individuals is 37%. Tensions escalating in Asia after India said it neutralized Pakistani drone and missile attacks targeting several military sites on Thursday night. India's defense ministry says military stations in some of its northern cities were targeted and no casualties were reported. Pakistan denied that it launched the attacks, saying the claims were politically motivated. Coming up, cuts and relief. The Trump administration mulls changes to tariffs against China. Ahead of this weekend's meeting, we'll have the details next on your Bloomberg Brief.
Any country or any groups of country talking about isolating China, do you know what's the response? We chuckle. Because from my perspective, it's a mission impossible.
If the Chinese don't want to renegotiate, well, that's their choice. But it is American options for what they want to do that is driving this. It is not holding a gun to the head. It is trying to take a different course in history.
It's reasonable to expect that a similar approach could happen with China, and that the negotiations or the tariffs could be paused for 90 days while the two sides negotiate. And I think almost anything less than that is going to be seen as a disappointment by markets and by observers.
The Trump administration considering a significant China tariff reduction as the team gears up for trade talks. The meetings are expected to take place in Switzerland over the weekend with U.S. Treasury Secretary Scott Bessent, Trade Representative Jamieson Greer, and Chinese Vice Premier He Lifeng. All will be there. For more, we are joined now by Bloomberg's Josh Gallo. Josh, what are we expecting this weekend?
Well, all eyes are going to be on Geneva, where Bessent is meeting his counterparts. And I think the main thing that we're looking for here is de-escalation. So both sides have really dug in over the last several weeks. The tariffs are at 145% with China for the U.S., and I think the goal going into this is for both sides to reach some sort of an agreement that can signal that they're on a path to talking through these problems. So Sean Donnan, our reporter in Washington, he's written that the U.S. is ready to perhaps drop that 145% rate that's there down to 60 as initial gesture of easing tensions. They're going to be looking for some assurances from China on imports of rare earth materials that are used for magnets, the fentanyl crisis, things of that nature. But really, this is initial. This is not going to be the details. We're looking to see something that sets the stage for the next few months of negotiations to see if things can move forward in a more detailed way.
Well, speaking of things that set the stage, we finally got the U.S.-UK trade deal yesterday. 10% tariffs stay in place with just some adjustments around the edges. Josh, to what degree is this, or is it not, a blueprint for negotiations going forward for other countries?
I think it's certainly a blueprint for other countries, but not necessarily every country. So the administration here is signaling that, of course, they took a really firm stance in April with all of their reciprocal tariffs. And, you know, the UK is obviously a country that Trump himself has always wanted to have a big trade deal with. But even there, you know, so we see this initial, what's billed as a success by the administration, but it is really bare bones. So I think what they're signaling is that this immediate approach that they took in April with these high tariffs can quickly rebound into a more palatable general level if countries come to the table and if countries that offer some sort of sacrifice that the U.S. is looking for. You know, Trump on many levels, not just trade, oftentimes wants to come in hard and then, you know, for political reasons, signal some sort of victory, which he clearly did with the UK, but the details there are scant. So, again, that could be what we see out of China, too, some sort of initial framework-style agreement about moving forward. But, you know, it does look like a playbook, but I'm not sure it's going to function for everyone.
Elsewhere in Washington, Josh, we have Trump campaigning lawmakers to seek a tax hike on wealthy individuals earning $2.5 million or more. I think the figure is something like $5 million for couples at a 39.6% tax bracket. Is this something that can actually get through Congress?
Well, look, it does seem possible. You know, more than a month ago, they were suggesting raising that rate on people earning $1 million or more. And since then, now it's up to $2.5 million and more annually. So, you know, they're trying to balance the massive tax cuts with the fact that they have a very you know, the Republican Party, that's not going to hit many of their voters across the country, right? They're going to have to show that the tax cuts are not just going to be borne by people earning less, that people earning more are going to pay part of that bill. So, you know, in the broad scene, it's against Republican orthodoxy to then have a tax cut, a tax increase on the wealthy. But you have to look at this more broadly. You know, are people who are earning $2.5 million a year on net, are they really going to experience a higher tax burden if the whole package goes through? I think the answer is probably no. The estate tax has been doubled under Trump. The estate tax exemption has been doubled under Trump in his 2017 tax cuts. You have to look at capital gains, things like that greatly affect that segment of the population. So, you know, and again, 37% to 39.6% is not necessarily the kind of increase that would break someone's back at that point. So, and I think Bloomberg has estimated with the tax foundation that's less than $70 billion in additional tax revenue over 10 years. They're looking for massive tax cuts in the trillions. So, again, we'll have to see. I think that the more populist Republicans in Congress would be happy to see that go through.
Josh, thank you so much for joining us this morning. Enjoy your weekend. That is Bloomberg's Josh Galou. Now, over in Europe, earnings continue to roll in. IAG beat estimates for revenue and announced a major order for both Boeing and Airbus jets. That's the largest order for the parent company, British Airways, in recent years. For more, let's bring in Bloomberg TV's own Guy Johnson. Guy, great to see you this morning. We also saw part of this order specifically with the Boeing jets tied to the UK-US trade deal. At least that's what the Team Trump started to tout. So can you separate for us the politics of this deal versus actual need for IAG?
So IAG, this order started a long time ago. IAG has been looking to expand its long-haul fleet, and this is part of that story. It's part of an ongoing story. We have seen another big order from IAG only a few months ago. So this is part of a long-term strategic plan that IAG is pushing through to expand its wide-body fleet. Part of it is going to be for replacements of existing aircraft. They've got a lot of 777s, Boeing's 777 in their fleet at the moment. Some of the 787s that they're ordering will replace those aircraft. But they're also looking to expand as well. So that's the kind of the fleet story. They want to expand the fleet. So what is interesting about this order, Danny, is that there is an element of politics to it. So they are ordering Boeing aircraft and Airbus aircraft. But it's interesting to where those aircraft are going to go. So the Boeing aircraft are going to go to the UK. And the Airbus aircraft, they're ordering A330neos, are going to go to other parts of the business, for instance, Iberia, Aer Lingus, other parts of the business that are inside the EU, two different jurisdictions. So Boeing goes to the UK, and that is now being facilitated by this new trade deal, which will make that a lot more possible. And the Airbus aircraft go to the EU. Now, this is raising interesting questions for others within the region. For instance, Michael O'Leary over at Ryanair, probably the biggest importer of Boeing aircraft in Europe, or Carsten Spohr over at Lufthansa. He's got a load of 787s. I think they're already built. I think they're sitting at Charleston right now. What does he do with those? Because it looks like the Boeing Airbus story could become part of the EU-US story, and we don't know which way that's going to go. So this is part of a long-term plan. It was already in train. But it's interesting that we are seeing actually the tariff story, the politics story, having an impact here in terms of where the different aircraft are going to go within the IAG fleet and where it is possible to import those aircraft without any tariff hit coming through. So it's a little bit of both. There is a tariff story here. There is a deal story here. But there's also a long-term fleet planning story as well, Danny.
Guy, it is so fantastic to have you on. Thank you so much for joining us. That is Guy Johnson in London in the latest for IAG and Boeing and Airbus. Coming up, we're going to wrap up the week with a deluge of Fed speak. We also have trade talks over the weekend. We're going to break down your diary for the day from a cloudy New York City coming up next on your brief. Let's get you set up for your trading day on this Friday. We're going to get a slew of Fed speak on deck. That starts with Governor Michelle Barr. That happens basically now. Plus, don't miss our exclusive interviews with Governor Adriana Kugler, 7:15 a.m. Eastern. Over the weekend, trade negotiators from the U.S. and China meet in Switzerland. Quickly, let's just get through some earning movers. Pinterest extending double-digit gains. It topped estimates. Lyft, that is up more than 7.5%, also rising its bookings beat. Finally, Expedia, that fell 9.4%. Softer travel demand. Piper Sandler also cut to underweight after that move. All right, that is it for your Bloomberg Brief this morning. Surveillance will take the reins from here. This is Bloomberg.